Hello, my name is Troy Emory, Managing Partner of TD Emory CPA and Associates. Today we're going to talk about the new tax changes in reference to businesses, LLCs, corporations, all the pass-through entities, and all the good things that are coming out as far as the ways to save you money on your taxes, especially you business owners. All right, there's a lot of words on this page, but I think this is important. This is why we put this up here. Well, when they were making the tax code, I don't know whether you remember this, but the Trump administration said that, hey, look, if you qualify to get this 20% deduction, I'm not going to allow a service business, a business where you say you're the only employee, you're the only person working here, and the business relies solely on you. I'm not giving you the deduction. And that caused a big stir. What happened was the Trump administration came back and said, okay, if you are one of these, I'll read them off to you, in the fields of health, law, accounting, actuary service, performing arts, consulting, athletics, financial services, investing, investment management, trading, dealing in certain assets, or any trade or business where the principal asset is the representation, is the reputation, or the skill of one or more employees really drives the business. Okay, first of all, who does not qualify here? It seems like he's covering everybody, but there are some people that don't fit in here. I don't see like construction, but if you look here, just about everybody falls into this category. So what they're saying essentially is you're an SSTB, specified service, trade, or business, if your income is less than $315,000. Your taxable income is less than $315,000 if you're married. And if you're single or other, $157,500 is the limitation. Okay, so if your spouse here makes a lot of money, she's going to bump you out. He or she is going to bump you out. Okay, so this is taxable income combined. It's not taxable income of your business. So as long as you're staying within these numbers here, you're okay. So one thing that we're going to talk about in future seminars, we're going to talk about when is it advantageous to stay as, let me go back here, one of these, an LLC, S Corp, and sole proprietor. Because as you see here, as your income keeps climbing, you're going to get to a point where you're going to say, hey, look, why don't I just go for the flat tax, right? So we'll talk about that in the future seminars. We just got so much to cover today that I don't think that I would have been able to cover it all. Because this law really, it gets really complicated. Oh, I thought you were going to say simplicity too. Anyway. All right, so here's a third thing. If you are not an SSTB, then you're going to be limited based on the amount of W-2 wages that you pay out. So I think the rule is you're going to be limited to the lesser of $50,000 of wages that you pay out, or $25,000 of each individual. You don't have to memorize all this stuff. It just gets really confusing. But the point is, there are certain wage limitations for people that are not a SSTB. Okay, and then if you purchase assets, you're going to have to add those purchased assets to your income to see whether, this is not to tax you, this is just to see whether you qualify. Okay, the key things is two steps, two hurdles you got to cross. You got to see whether you qualify, which these three slides here basically told you whether you qualify. Okay, this is the type of business that will determine whether you qualify or not. This is if you are a trader business, right? And if your income is under certain thresholds. So these are more, do I qualify for the deduction? And then after you have passed a series of tests and say, okay, yeah, I'm looking good, I qualify, then you got to go through a process where you calculate the DBI deduction. So QBI. So basically, you may not get 20%, all right? Because if you got these things going on, which doesn't affect a lot of taxpayers, just, I would say, you know, taxpayers are very savvy investors. Real estate investment trusts, which are REITs, if you have one of those, dividends from a publicly traded partnership, these are more sophisticated investors here. Then you're only limited. I'm sorry, you're going to have to add this back to your income here, not to be taxed, but to determine how much you can actually deduct. Okay, 20% of your taxable income minus net capital gains. Now, I'm going to tell you why this is in here. If you think about it, if you're already getting capital gains, you're already taxed at lower rates. All right. So to give your deduction and let you take advantage of the capital gains, you know, it would have been too much. You would have got a double benefit here. So what you have to do is you have to subtract out your capital gains. So as you see here, it's just not a straight calculation. There are some complications to this thing. And I'm just waiting until next year to see how they all play out. So I put this in here to show you one thing. Let's see if this is the one that's in here. Standard deduction, refundable credit. Oh yeah. If you recall the second page of your 1040, once you got the taxable income here, then you did your tax. But you notice here there's one additional line right here. See that? This is your qualified business deduction here. Okay, so this is where you're going to be able to find that deduction. You're going to have to go on this like a Schedule C and put in certain information about whether you qualify or not, or if you're in 1120S, LLC, you're going to have to go to those particular forms and put in qualifying information, the stuff that I showed you before to say, hey, do I qualify? You're going to do that all on the business returns. And then when it comes to your personal return, this is where you take the deduction here. Okay? So in this case, we had someone's wages of $100,000. They had the business income of $98,197. So basically, it was basically 20%, a little bit more than 20% of this number here. Okay, we probably got some other business income in the return that gave them a little bit more, but as you see here, this is just over 20%. And again, we probably got something else in here that's driving that number up. I hope you enjoyed the video that you just watched. If you got any questions or comments, please contact me at tdecpa.com or 301-474-1040. Thanks, and hope you enjoy your next video. Don't forget to hit subscribe so you won't miss my next video.